Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw, senior market specialist at FXCM. My email address is arthur@fxcm.com. Today's Thursday, it's the 7th of July, 2022. Just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments. Hey, Katie, Howard, morning to you guys. Nice to have you on the webinar. Thank you, everyone, for joining. Rob, I do know I've got some emails that are outstanding. I'll reply to those today. I'm begging your pardon, but I want to just thank everyone for logging in so early this morning. I'm going to bring up our market commentaries disclaimer as well. Okay, and just in terms of our references, we'll start off again going through the article from cnbc.com. We'll take a look at tradingview.com and MarketScope. In fact, I'll just keep this on screen while I go through the CNBC note. So this is the 2s, 10s yield curve, and I think now we've got something to talk about. It's not sort of a touch below the inversion. Now we've got an inversion. Okay, so that's worth just, I think, talking about. Just maybe change it to a weekly. Yeah, it's better. All right. There we go. All right. Whilst Rob's saying I've shared two screens. All right, that's odd. Let me see what I am doing wrong here. Sharing. All right, there we go. I'm begging your pardon. Okay. All right, there we go. All right, there we go. All right, thanks for that. All right, can you guys just see the chart now? Should just see the chart now. Beg your pardon for that. Okay, cool. All right. Let us go through to the CNBC article. Okay, so it reads the headline as follows: European markets look to build on gains as investors digest Fed minutes. And European stocks are expected to open higher on Thursday, building on gains in the previous session. European markets are set to build on gains seen on Wednesday, with the Pan-European Stock 600 closing up to 1.7%, closing up by 1.7%. Beg your pardon. Tech, media, and retail shares climbed over 3% to lead gains, as almost all sectors and major bourses ended in positive territory. Investors will be digesting the latest Fed minutes released Wednesday, in which the central bank officials reiterated a tough stance against inflation, saying another 50 to 75 basis points move would likely be appropriate at the July 26-27 meeting. I just want to take a pause there. These minutes are about three weeks old. All right, they're out of date. they're out of touch of what's going on in the markets right now. So I'm not sure why there's such a huge emphasis here. The whole point is that we've got this huge inversion, okay, which is a new dynamic. So yes, whilst I would certainly agree that the Fed's minutes need to be read and digested, we must realize they're 3 weeks out of date. Okay, things have changed quite significantly on the ground. So just keep that in mind. Federal Reserve officials recognize that a more restrictive stance in policy could be suitable if inflation doesn't ease, even if it slows the economy, the meeting minutes said. Participants recognize that policy firming could slow the pace of economic growth for a time, but they saw the return of inflation to 2% as critical to achieving maximum employment on a sustained basis, the document said. Overnight, Asia-Pacific markets were mostly higher on Thursday, while US stock futures were flat on Thursday Thursday morning as investors digested the most recent meeting minutes from the Fed. The ECB will be publishing the minutes of its last meeting on Thursday, while the group of 20 Prime Ministers met in Bali. Sainsbury holds an annual general meeting and data releases include German industrial production figures for May. All right, so that's the news item. So the idea here is that central banks are still looking very much to tighten. However, okay, they don't operate, in a vacuum. There is a huge buildup of pressures here. The market volatility over the last, let's call it the last 48 hours, has been intense. Perhaps a little bit of release yesterday on the markets, but we saw the euro-US dollar heading quite strongly towards parity. We'll look at that in a moment. The idea here is I'm not convinced that any central bank policy is fixed at the moment, just because there does seem to be some change-ups on the ground. Initial unemployment claims, we've got to keep an eye on that. Tomorrow, non-farm payrolls, which reminds me, we're going to have the trade. I'm going to pop the link in. Okay, so that's in the chat. Just let me know if you can get it. Joachim, did you get the link to that? I know you couldn't see it on screen. I still can't figure out why yours was grayed out. But just let me know if you've got the link for it. Okay, so I did reply to your email, Joachim. If I may just ask you to check your spam folder. For some odd reason, my emails often end up in spam. I think it kind of is part of the algorithm. Can you just double check that it's in your spam folder? If it's not, just send me an email again. But what I'll try to do is actually send the link to you privately as well. Just let me know if you get this, Joachim. Okay, cool. All right, excellent. All right, good. No worries, Howard. No worries. Understood. Okay. So the idea here, guys, is we've got this inversion. Now, what I want to do with this inversion, which we looked at earlier in the week, I want to add the initial jobless claims underneath this. So let's just click plus. All right, let's just bring this in. I'm going to go underneath this. So here's the new pane. And I want to put continuing claims underneath this as well, right? So now I think we've got a fairly good picture when we add the continuing claims. Never spell this correctly the first time. There we go, continuing. So let's put this underneath that as well. And what we need to do is we just need to change these guys up to the logarithmic, because it's going to be very difficult to see what's going on without a logarithmic scale. And let's just make these into black thicker line charts. I think it's just easier to see. Okay, cool. All right. Now, what we want to do here is just keep an eye on the inversions, the previous inversions. Let's just see how far back we go here. All right, so we go back to 89 over here. Where was this inversion? It's quite odd just to see the inversion here. I'll tell you why it's odd, going back all the way to 88. Because Black Monday was 87. I think it was called Black Monday. That was the sell-off in 87, which was blamed on, I think, algorithms or 80s equivalent of algorithms. So it's quite interesting just to see it's interesting to see the inversion here in 88. But the point is, it inverts, and then we see the initial claims moving up. It inverts, and we see the continuing claims move up. Okay. I'm not sure why I've got this one in. Let me just see. There's probably a small inversion here. This, I think, is negligible. It's probably not what we're looking for. But this second one over here certainly is a significant inversion. And here you can see initial claims moving up, continuing claims moving up as well. Let's take off the third. Okay, let's just go through to our third one. Again, initial claims moving up, continuing claims moving up afterwards. So we have these inversions, and then the job market reacts. Now that brings us through to, again, I want to disregard COVID. COVID really was a black swan, and none of us saw it sort of coming. So let's just disregard that. But now you want to keep an eye on the current inversion, and we kind of need to understand if the minutes, and again, I want to make this a capital I, capital F, because things have changed up. If the minutes do suggest the reality, in other words, we will see a 75 basis points in July, and we see a 50 basis points in September, this inversion has to get worse, because it's going to influence the 2-year. See, it's going to we know that we've looked at the relationship between the 2 years and the Fed funds rate. We've looked at that quite a few times. So the 2 years then moves up. The inversion gets worse, and then of course there is the idea that the initial claims, continuing claims can really start moving up. Now there's one saving grace here that we must acknowledge. Let me rephrase it. One potential saving grace here, which again we've looked at before. Let's just go through to the 2-year. So I'm going to add our 2-year here. And we'll add that as a new pane. And I'm just wondering if I can add the Fed funds rate on top of this. Let me just see if I can. I'll just add it underneath. It's okay. The point will be made. So I know we've got a lot of information on this. I'm going to start deleting some off. I just want to make a point, and then I'll take the last 2 charts out. Remember, we have mentioned that either the Fed funds rate is going to carry on moving up, and the US 2-year has overshot, and that's going to start moving down, or again, the statement's almost it's self-explanatory. It's either the US 2-year moves down or it's going to move up. So it's going to be one or the other. But the key here is we're trying to assess if the 2-year has overshot. Now, if it is an overshoot on the 2-year, okay, if it is an overshoot on the 2-year, we won't get into it too much today. We have spoken about it previously, and we will come back to it. Then perhaps this inversion isn't quite as severe. But assuming that this is not an overshoot on the 2-year and the Fed funds rate moving up, going to push the 2-year higher, then we are going to get that inversion. And if we do get that inversion, then I think the idea is the hard landing is very much a sort of a variable to keep an eye on. So this is now very, very important for us going forward, because what would tend to happen, of course, is that as unemployment increases, so does social unrest. Okay, so does social unrest. There's obviously a correlation there. And as social unrest increases, political pressure increases. So there's a positive correlation there, which of course makes for at the very least, very interesting macroeconomic analysis. And then it comes into question, can the central banks, which are meant to be impartial, right? They're meant to be impartial, but can they really operate in the environment of growing social unrest? The theory says that yes, they should certainly be able to do that because they have mandates to fulfill. Nevertheless, we are living in interesting times, so we want to keep an eye on that, right? Now, the inversion here is not only dangerous in terms of the hard landing via the initial jobless claims, which are out today. I think the initial jobless claims are out today. Non-farm payrolls are out tomorrow. JOLTS data yesterday actually came in. So JOLTS, Chris asked us about a week ago to take a look at the job openings. So what's interesting about that, Chris, there's a 2-month lag in that data. So where I think it's going to become very interesting is only in 2 months. So we'll have to see the JOLTS data in 2 months to see what's happening. So there's a lag there in that data, which unfortunately is not helping us with the analysis, right? But the idea here is, I think the inversion is probably where we've got to focus. That's real-time data. Now, given that the inversion is locked in, what's happening on the markets? So let's go through to our DAX, okay? And we've got this line of support. I think we've again got to keep an eye on that. The market is not oversold, so there's no temporary floor that's locked in at the moment. Okay, so the risk of further downside in the near term must be acknowledged. Moreover, the momentum is building quite severely to the downside. When we say that the stochastic is in the 20 area, we're not saying that the momentum is weak. Okay? What we're saying is the momentum is strong to the downside. When we go into the 80 area, we're saying the momentum is strong to the upside. So the fact that the stochastic is reaching that 20 area, we're saying that momentum is strong to the downside. That's a scary thought. Now, let's just take out the RSR and let's just focus on this week. Okay, and let's just try and understand the sentiment of this week. So let's put in an arrow. So what's happening here in terms of the sentiment? We know we're at support, and we also know that we've got a lower peak, lower trough. Okay, so those are the easy things. But if you take a look at the high-low range, okay, the high-low range does give us a lower high, lower low. See, that's lower high, lower low. The trend continuing down, but it's a confusing. Look how confusing this candle is. We've got a much weaker range. Okay, number one, but we've actually got some support still coming in here. Isn't that odd? So you've got this. Does everyone hear what I'm saying? Lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. That's all bearish. But look where the close is. Okay, the close has come off of this. So we just want to keep an eye on this. What I think may be happening here, okay, is that the support is starting to be defended. But what I'm worried about, that inversion and the momentum. So now the inversion, that's kind of your fundamental situation. The momentum, that's your technical situation. I understand we're looking at the inversion on a US and we're looking at the German index. I understand that, but the American inversion, I'm taking as sort of a global proxy. It may not line up exactly, but the idea is, America sneezes, the rest of the world catches cold type of a thing. So the idea here is the momentum building. So we've got some bulls trying to defend this area, And I'm just of the opinion that defending this area here is probably a highly risky endeavor. In other words, any sort of movement up here, okay, probably receives good press coverage because of just the nature of the sell-off. But I think it sets up again the next leg, or potentially sets up the next leg. So this, it looks to me to be the next pain, sort of the next pain wave kind of setting up. We don't want to be trapped in this. Where it will get more interesting and more positive is if we get the higher trough followed by the higher peak. Now again, we've spoken about this. We missed the bottom. I think we've got to be comfortable with that because it's very hard to know where the low is, or the bottom. It's impossible. Right? I don't know if we're at the bottom, but we could be. But we've got this inversion that suggests to me that there is huge risk. So the way that I think that we evolve from here is not with higher trough, higher peak, although that may indeed be the case. I don't feel that is the path of least resistance. I feel that the rallies are highly suspicious. I think they are bear market rallies. I think that it is something that we've got to be extremely wary of. So we could perhaps get the next, let's put this here. Put this here. And put this here. Now, clearly the last LP, LT, these actually should be question marks because it's just guesses at the moment. All right, but just the idea here is the way I think it may play. If we get any sort of support, any sort of defense at these levels, I'm not convinced, given where the momentum is and given the inversion. Now, let's just go through to our daily chart here. So what's happening here makes for tough market trading, because your stochastic has started to move out of this 20. The volatility also seems to be coming in a bit here. Okay, but again, to me, this is almost it's that sucking in mechanism. It potentially pulls us in where we think the worst is behind. Now, I want to be clear. I don't know if the worst is behind us. It very much may be the case. It very well may be the case. But the idea is I'd like to get some sort of indication of a higher trough, higher peak. Then the conversation can change. So the fact that there is a dip in volatility here is something which I think we need to be wary of, because it might pull us in, we expose ourselves, and then we get hammered again to the downside. Remember, it's not the bear markets that do the damage, it's the bear market rallies that do the damage, because we're always trying to guess where that bottom is. Very, very difficult to do that. And I think what we need to do is, of course, go back to the COPOC. So if we go, let's take these guys out. Let's bring in the DAX here. All right, now this is where it gets really super interesting. We're on the monthly here. Okay, we go through to, now we've dropped below 0 here. Okay. Now we've dropped below 0. Now this is where it gets really interesting, because it's effectively there's two parts to the COPOC. The first part is dropping below zero. We've got that. The second part now is the rollover, the turning up. Now it's a monthly indicator. So again, we'll be late, but we'll be pretty close to a bottom if the previous signals have anything to say about it. So the idea is, I think that we are heading towards value, okay? But the key here is we've got to wait for that turn up. In other words, if this inversion has an impact, and there is still major selling pressure to come, so the COPOC can drop. Let's say it drops from -7 to -20. Again, that's just sort of I'm just using those as an example. So there's the pain, -7 to -20. Then it turns up. By that stage, think about it. People have been battered. They bloody, they black and blue. They don't want to have anything to do with the markets because they've just been absolutely beat up. That's the time when you want to try and hunt for your value. When nobody else is touching the stuff, that's when the pros are starting to accumulate, right? That's what the COPOC indicator is ultimately designed to do. It's after the sort of the bout is done, you know, everybody else very wary of the markets. We can start going at picking up some really good companies at really cheap prices. So the fact that we've dropped under zero here is very, very interesting. Now, the other place, okay, the other place which is very, very interesting, it carries much more risk, but of course the China 50 is been absolutely battered. Okay, it's been battered, black and blue. Okay, you go through to the China 50, and all of a sudden, nobody wants to touch China. Well, that's probably a sign that we should be looking to see if there are some good companies here. There's some good companies here at ridiculously cheap prices. Now, China is difficult because there are regulatory interferences, okay, which are absent in other markets, but this is something that we need to just keep abreast of, right? You take a look at, so Katie is asking for the NASDAQ. We're definitely going in that direction. We're going to do all of the American indexes. So let's just bring up NASDAQ. Okay, so NASDAQ, we've dropped under zero now, right? Dropped under zero, okay? The drop below zero is not the signal. That's part one of two signals, okay? So we've dropped below, okay? We've dropped below. Let's go through to SPX. Okay, but did you see that China 50? That China 50 has already started turning up. And if you take a look at the major banks, you know, China has really got their attention at the moment. Really got their attention. Okay, so take a look at S&P 500. Okay, so here we're off. We're still above. Okay, so the S&P is still above. Okay, so perhaps some pain to come there. Let's take a look at US 30. Okay, still positive. So the Nasdaq starting to dip. Okay, now the DAX has dipped. China 50 has dipped. Let's take a look at the Russell 2000. Okay, Russell 2000 really dipped quite severely, -20. Let's just put in the zero here. So we kind of in those value territories now. A few of these indexes They're not all there, so maybe that's where we've got to be a little bit wary. That's where we've got to be a little bit wary, is that I think if they all kind of drop below the 0 line, I think that makes for a more compelling case. But that's the technicals. That's the technicals. Then we've got to try and marry this together with the minus 20. So think about it though on a relative basis here, Anna. So minus 20 just for this, because of the way that the indices are calculated, you're always going to get different. So just look at it in terms of sort of relative position. So perhaps minus 20 might generate a signal. It might generate a signal, but it just seems that perhaps, you know, maybe minus 40 is kind of the area to look at. Again, it doesn't really matter. We're under minus 20. It's now time to look for the pickup. The idea here is not really the minus 20 in terms of minus 20, say, on the other COPOCs. These are all going to be self-contained because the indices, the indexes are all going to be very different values. So the idea is we're just going to look at them, not compare them. Look at each one in its own way. All right, so let's just try and understand this with the fundamentals, because this is where it gets very difficult. We're trying to marry the technicals with the fundamentals. This is where it gets very, very difficult. The idea here is we've inverted. Okay, we've got an inversion. How does that factor in with the fact that the COPOCs are starting to get into that territory where they're starting to look a little more compelling? And the best I can come up with at the moment, and I'm going to say this is 100% subject to correction because this is more guesswork than anything, is that I think there's more pain to come here. In other words, I think we do get the S&P, we do get the Dow Jones hitting the negatives on the COPOC. If that's the case, then I would expect more pain on the Russell, more pain on the Nasdaq, even more pain on the DAX. But I think the fact that the COPOCs, some of the COPOCs are hitting that minus 20 means we're getting pretty close to the end of this of this particular economic trough. So that's my reading at the moment. There's a huge caveat here. I could be completely wrong. It's subject to correction. I feel as we kind of heading towards that trough. We're not quite there yet. I think that inversion is what we've got to keep an eye on. Because we've inverted, we have to keep an eye on initial jobless claims now. That means we have to keep an eye on continuing jobless claims, and it means we have to keep an eye particularly on the US 2-year, because if it's an overshoot, then that inversion is not going to be as severe as I think it could be. So there's a lot of question marks at the moment. It's making for a very, very difficult market. However, the COPOC indicator ultimately is kind of guiding us here. It hasn't turned up yet. It's a 2-signal system, only one of the two. And again, you need 2. Okay, one's not good enough. You need both. Okay, just like our reference candles, having 2 out of the 3 not going to help. You need the 3. You need the third one where you have nothing. Same with the COPOC. You need number 2 or you have nothing. The one part that's really, really interesting, and is this guy here. To me, this is so. I've been watching this for quite a while now. Every once in a while, I'll sort of draw our attention to it. The reason is because it's really unloved. It's really unloved, and that's exactly the whole point. The pros are collecting when something's unloved. They're offloading when it's completely loved. Okay, so this kind of turnout here has really got me very, very interested. Okay, we've got to be careful because, of course, China is part of the global economy. if the global economy continues to capitulate, then this could be a whipsaw signal, and it can move completely and can move further down. It's happened before. It's happened over here. So the COPOC indicator here, again, is not infallible, but to me this is really, really interesting. Okay, this is really an unloved index, and that's exceptionally compelling because it's completely contrarian. So we want to just keep an eye on that. And we are certainly moving into a very, very interesting stage that if it sort of plays out in almost in a linear type of fashion, which is, again, a big if, right? But if it plays out linearly, then the idea is there is certainly opportunity. So yeah, so Anna's making a good point. I think that the zero COVID policy is dangerous here because you know, if there's no economic activity, how can the Shanghai 50 move up? Yeah, of course. That's the point. There is a high. So this, the only way I can answer that, Anna, is there's 2 points. The first point is you're right. Okay. The second point is that because you're right, there's a higher risk premium. Okay. Because you're right, there's a higher risk premium. That means if there's a higher risk premium, the market's going to require higher returns. That's your risk to reward. Again, where you focus on, you know, logic says, well, focus on the risk. So you're 100% right. But if we do get a COPOC signal here, and let's say all the lockdowns have been priced into the market already, it makes for a very compelling case. Okay, because think about it, you've got to try to get your money work somewhere, somehow. China 50 is a glaringly obvious choice here. Whether it pans out or not, that I don't know. There's huge risk involved here, higher risk premium. That in itself may disqualify it right off the bat for the more sort of risk-sensitive type of player. I haven't done anything with this yet, but it's certainly on my radar. So I just wanted to, I've been keeping an eye on this for quite some time. Ever since it crossed below that zero, I've been waiting to see when it turns up. Now, the turn up in the COPOC, by the way, the turn up in the COPOC is not an outright buy signal. It's the first part of a system. So yeah, we may have bottomed. Now you start looking at other things. Do the fundamentals warrant it? Do the other technicals warrant it? But the point is, it's part of the toolbox. Yeah, understood. So, and Anna has sort of, you know, issues with the political side of China, and of course, you know, understood. And I'll give you an example of that, by the way. So my father never would invest in a cigarette company. Never would do it. Just couldn't put his money into a cigarette company. Would never put his money into a gun company or a company that manufactured weapons of any sort. He wouldn't do it. That was his line in the sand. So I understand. All right. I think we can call it over here. Any questions? Any questions? All right. I think what we'll do then is we will conclude here. Have a good day, guys. Tomorrow is the live. Tomorrow is the live trade on a live account. Please join me for that. Thanks very much, guys, and chat to you all soon. Thanks.